Welcome to the Interim platform. Today we'll be discussing about the introduction to the union budget, its history, types and the presentation process. And also there's a thing to be remembered that the union budget 2023-24 that is set to be presented in the parliament on 1st of February will be the last full year budget of the Narendra Modi government before the Lok Sabha elections that are going to be held next year. And given this timetable, there is an expectation that the budget could be populist in nature but with high inflation. But there are questions about the government's ability to spend freely at the moment. So, this lecture will contain everything that needs to be discussed and is important in relation to the topic budget, and it will be quite beneficial for students pursuing for UPSC, state PCS, railway, and the other related competitive examination. So, stay tuned till the end. What is government budgeting? So, a budget can be defined as an estimation of the revenue and the expenses of the government for a future period of time, and it is usually compiled and reevaluated on a periodic basis, that is for a financial year which is from 1st of April to 31st of March. Now, the term budget was derived from the word bogoti, meaning a leather bag. Now, the Article 112 of the Indian Constitution states that the government should lay before the Parliament an annual financial statement which should contain the estimation of the revenues and the expenditure of the government for that year, in this part referred to as the annual financial year. So it is laid on the table of the Rajya Sabha at the conclusion of the speech of the finance minister in the Lok Sabha, and the budget is divided into three parts, that is the consolidated fund, the contingency fund and the public account. We'll be talking about these three funds in detail in our slides ahead. So talking about the presentation of the union budget, in India the budget is usually presented to the parliament on a fixed date as decided by the president, and from 2017 it is 1st of February of every year, and earlier it was the last day of February. So since 1999 the general budget is being presented at 11 a.m. Earlier to that it was presented at 5 p.m. Now the House, which generally seeks to the presentation of budget, so the general budget is presented in the Lok Sabha, and why is it there in the Lok Sabha and why not in the Rajya Sabha? So the main reason behind it is the Lok Sabha is the Sabha of the people, or the Sabha of the Lok, which means the House of the people, and it is directly elected body, and also all the money bills are first introduced in the Lok Sabha. So budget is a money bill and therefore it is introduced in the Lok Sabha. Then by whom is it presented? So the Finance Minister of India presents the Union Budget of India. Now, usually the budget speech is in two parts. The first part, that is part A, deals with the general economic survey of the country, and part B relates to the taxation proposals. Now, the highest number of budget. Now, as of September 2017, Morarji Desai has presented 10 budgets in his tenure, which is the highest, and he holds the record of presenting the highest number of budgets in his history. And during his tenure as a finance minister in 1962 to 69, he presented 10 budgets, followed by P. Chidambaram, who presented 9 budgets, which was followed by Pranab Mukherjee, presented 8 budgets, and Yashwant Sinha also presented 8 budgets during his tenure, and lastly, Dr. Manmohan Singh presented 6 budgets. Now, talking about the three funds of the Government of India, First is the Consolidated Fund of India. This is the most important of all the accounts of the government, and this fund is usually filled by the direct and the indirect taxes, that is loans taken by the Indian governments, then returning of those loans or interests of those loans to the government by anyone or by any agency that has taken it. Then the government meets all the expenditures of any work from this fund, and the government needs parliamentary approval to withdraw the money from this particular fund, that is the Consolidated Fund of India. The provision for this fund is given in the Article 266(1) of the Constitution of India, and each state has its own consolidated fund of the state with similar provisions, and usually the Comptroller and the Auditor General of India audits these funds and reports to the relevant legislatures on their management. Then the second fund under the Government of India is the public account. This is constituted under Article 266(2) of the Constitution of India, and all the other public money other than those that are that the Consolidated Fund of India constitutes are received by or on behalf of the Indian government are all credited to this fund itself, that is the public account. And this is made up of the bank savings account of the various ministries or departments, the National Small Savings Fund or the Defense Fund, then the National Investment Fund, that is money earned from disinvestment is also credited into the public account, then the National Calamity and Contingency Fund, that is for disaster management, and the Provident Fund, the postal insurances, and etc. So all these gets credited into the public account fund only. Then the government for any expenditure does not need any permission to take advances from this account. Each state can have its own public account or public fund, as was there in case of Consolidated Fund of India. Then the audit of all the expenditure from this particular fund, that is the public account of India, is taken up by the CAG. Then talking about the contingency fund, that is the last fund constituted by the Government of India. So this was made by the Article 267(1) of the Constitution of India, and its corpus is rupees 500 crores. It is in the nature of an imprest. Imprest means money maintained for a specific purpose and is used for a specific purpose. What is that specific purpose? So contingency fund is always used in case of unexpected or unforeseen expenditures. Then the Secretary of the Finance Ministry holds this fund on behalf of the President of India. And again, each state can have its own contingency fund established under the Article 267(2) of the Indian Constitution. Now talking about the types of budget, so we'll be talking about three main types of budget, which are balanced budget, deficit budget, and the surplus budget. So what is a balanced budget? It is one in which the government's predicted revenue for the year is equal to its anticipated expenditure. That is, the total budget expenditure will be equal to the total budget receipts. Now, for example, if the budget expenditure of the government is rupees 2 lakh crores and if the budget receipts are also of rupees 2 lakhs crore, then there is a balance between the expenditure and the receipts. So it is called a balanced budget. And it is based on the classical economist theory of expenses not shooting over the receipts and living within the means. However, when the economy is in the state of financial turmoil, a balanced budget does not always ensure stability of the country. Then the second budget is deficit budget. It is the budget in which the expected government spending exceeds the expected revenue of the government. That is, the expected revenue of the government is less than the proposed expenditure of the government, and the budget is said to be deficit if the expenditure surpasses the revenue over time. That is, the total budgeted receipts is less than the total budgeted expenditure. Now, for example, if the budget expenditure is rupees 2 lakh crores and if the budget receipts are rupees 1 lakh crores, then it is called a deficit budget, means the government is in a deficit. The shortfall is usually compensated by borrowing from public or uh, taking out funds from the reserve surplus, and in certain ways a deficit budget is a government's liability. And the government budget, the deficit budget is used to finance the planned development in the developing countries and is used as a stability tool to limit the business and the economic swings in the rich countries. And during recession, what happens? The government incurs additional expenses to increase the employment, which boosts demand and drives the economic growth. Lastly, coming to the surplus budget, when the year's predicted revenues exceeds the planned expenditure, the budget is said to be surplus in nature, which means that when the total budgeted receipts are more than the total budgeted expenditure. For example, if the budget expenditure is rupees 2.4 lakh crores and if the budget receipts are rupees 2.8 lakh crores, then the budget is said to be surplus in nature. That means the receipts are exceeding the expenditure of the government. So, according to the economists, a surplus budget can be utilized to decrease the demand during inflation. So now in this slide, with respect to the history of the Indian budget, I have shown the various budgets and from the independence to the current time, and the important steps or the important measures taken by the government in order to improve the budget, or the characteristics of that particular budget are mentioned. So first being the first Indian budget. So the budget was firstly introduced in India on 27th of April 1860 from East India Company to the British Crown, and the first Indian budget was presented by Sir James Wilson on February 18, 1869. Then talking about the first finance minister. So the first finance minister of independent India and the first budget was presented by him. So he is none other than Mr. R.K. Shanmugam Shetty, and it was presented on 26th of November 1947 in the backdrop of the partition and the riots that took place because of the partition of India and Pakistan. So for the first time, the finance minister, that is R.K. Shanmugam Shetty, used the term interim budget. So, what is interim budget? So, the interim budget later became an institutional process. For each year, the general elections are held. Primarily, an interim budget denotes a short term budget which is presented just before the Lok Sabha elections are held. Now, Union Budget 1958 to 59, for the first time in the history of independent India, the budget was presented by a prime minister who was a who was none other than Mr. Jawaharlal Nehru, who decided to carry out the responsibility of presenting the budget and took the opportunity to introduce a new taxation instrument which was called the gift tax. Then Union Budget of 1970 to 71. So this was the only budget in the history of independent India which was presented by a woman just before Nirmala Sitharaman presented the Union Budget 2019 to 20. So Indira Gandhi, who was the then Prime Minister of the country, took the additional mantle of the Finance Minister to present the historic budget. Then talking about the Union Budget of 1973-74, so it was known as a black budget as the nation had a deficit of rupees 550 crore under Pranab Mukherjee, the first Rajya Sabha member to hold the finance portfolio. Then talking about the Union Budget of 1987 to 88, so again Mr. Rajiv Gandhi, who was the then Prime Minister, held the additional portfolio of the Finance Ministry. He presented the budget in 1987-88 and he became the third Indian Prime Minister to do the same. Now talking about the Union Budget 1993-94, so under this budget, the government announced the setting up of the National Stock Exchange, which currently functions as India's stock market. Talking about the Union Budget 1994-95, so in this budget, the then Finance Minister Dr. Manmohan Singh introduced significant reforms in the indirect tax structure of the country in the form of service tax. Thus, the government levied a 5% tax on telephone, non-life insurance, and stock broking services. Then talking about the Union Budget 1997-98, so this budget is often dubbed as the dream budget. Why? Because firstly it was presented by Mr. P. Chitambram, and he took several economic reforms and he introduced several reforms in India, including lowering of the income tax rates, removal of corporate tax surcharges, and the reduction of the corporate tax rates. So, talking about the Union Budget 2000 to 2001, so this budget is often dubbed as the Millennium Budget as it transformed the Indian economy into a tech hub. And also the government here introduced the Kargil tax, which levied an additional 5% surcharge on the salaried individuals with an annual income of more than rupees 1.5 lakh, and this move was aimed to offset the cost of Kargil war partly. Then talking about the Union Budget 2006-07. So here for the first time, the government introduced the Goods and Service Tax, that is GST, in an attempt to systematically overhaul the tax structure by 2010, and it eventually rolled out 7 years after its initial date. Then taking into consideration the Union Budget 2013-14, so in the last budget of the Finance Minister, Mr. P. Chitambram, he introduced a new taxation concept known as the super rich tax for those individuals which had more than rupees 1 crore of taxable income. So thus these relatively prosperous individuals had to pay an additional 10% of surcharge. Then talking about the Union Budget 2017, so here the Finance Minister Mr. Arun Jaitley in 2017 took two important steps. First being the merging of the railway budget with the general budget, and secondly, the advancing of the budget presentation from the last day of February to the first day of February. Now, talking about the current budget, so Finance Minister Nirmala Sita Raman path-breaking Union Budget of 2019-20 strives to take the country to newer heights of development with the introduction of several intuitive reforms such as more relaxed taxation norms, then faceless e-assessment, direct tax reforms, and such more. Now, so the difference between the interim and the annual budget is very important, and it also had come in one of the years of the UPSC mains paper. So the main difference between the interim budget and the annual budget are, firstly, the time of the presentation are quite different. So the interim budget the central government of India presents the interim budget just before the general elections, and the annual budget is presented in the Indian Parliament by the Indian government. Then about discussion. So no discussion takes place in the Lok Sabha before the presentation of the interim budget, and a complete discussion takes place in the Lok Sabha before the passing of the union budget. Then what does the interim and the annual budget include? So in the interim budget, the annual income and expenses for the whole year are mentioned, and the first part of the union budget deals with income and expenses of the previous year, and the other part deals with the government's plan to raise funds through different measures and utilization of those funds for the development of the country. So now the last thing that we'll discuss is the FRBM Act. So as the years have rolled by, fiscal deficit have become a very important or key factor to watch out for every budget presentation, and it is considered most important maker of government's financial health. So a government that abides by the FRBM rule enjoys greater creditability among the rating agencies and market participants, both at the national level and at the international level. So the fiscal responsibility and budget management is an act of the parliament that set targets for the government to establish financial discipline, improve the management of the public funds, strengthen the fiscal prudence, and reduce its fiscal deficits. And it was first introduced in the Parliament of India in the year 2000 by Vajpayee government for providing legal backing to the fiscal discipline to be institutionalized in the country, and subsequent the act was passed in the year 2003. So the main features are that it must be placed along with the budget documents annually in the parliament, keeping in mind the three things, that is macroeconomic framework statement, medium term fiscal policy statement, and fiscal policy strategy statement. Then the main fiscal indicators, or the four fiscal indicators to be projected in the medium term fiscal policy statement are: firstly, the revenue deficit as a percentage of GDP; secondly, fiscal deficit as a percentage of GDP; thirdly, tax revenue as a percentage of GDP; and lastly, total outstanding liabilities as a percentage of GDP. So in the picture you can see the targets of the FRBM Act 2003. So you can just go through it, like reduce the fiscal deficit by 0.3% every year, and bring down to not more than 3% by 2008 to 2009, and the government shall cease to borrow from the RBI by 2006-7, and also the government shall report change, if any, in the accounting procedure to the parliament. Then the government shall not provide guarantees of loans in excess of 0.5% of GDP, and the government shall not incur additional liability of 9% of GDP each year. In this slide, I've tried to cover the important questions related to budget, and I've also given the answers to these questions in my slides. So for getting the answers, you can just go through my entire video, and if you have any doubts or any inquiries, just ping us up on our website of Arthrun, and we'll be really happy to help you out. Thank you so much for watching our video, and I hope you liked it. And for such more innovative and informative videos, you can subscribe to our YouTube channel titled We Educate, follow us on Instagram, and also check out our Arthrun website. Thank you so much. Have a nice day.